The Money Show.
Investment School.
Chantal Marx in the flesh, the head of equity research at F&B Wealth and Investments. Taking risk is a requirement of investing. And I wonder whether or not that undermines, in some people's minds, the notion of taking investment. Because, what do you mean I've got to take risk? No, I'm not going to take risk. I'm going to put cash in the bank and get a 5% interest rate. It may not beat inflation, but at least my money is safe. I'm not going to take risk. But even that's risky, right?
It's absolutely risky. And I think the biggest issue is how risk is defined by investment professionals in particular. So as investment professionals, we get learned that volatility is risk. Things that go up and go down and go up and go down.
As things are at the moment, massively volatile and uncertain.
That is super risky. But the flip side is also risky. The real risk is that you are not going to beat inflation. Your savings are actually not safe because they're deteriorating in value after inflation. And whatever you're saving for, let's take an example of retirement. If you are not taking appropriate risk as per that definition of taking some volatility, then you could be in a situation where you're not going to meet your retirement savings goals because you just...
Volatility is a wonderful tool. It is awful if you are somebody who is not earning and contributing to savings, because what you're seeing is on a daily basis the value of all of your assets fluctuate wildly. Today you're 1% poorer than you were yesterday, but yesterday you were 1% richer than you were on Friday, and it's all very distressing if you pay too much attention to it. In the world of people who are still earning and still putting money away, you want volatility. Volatility is your very best friend, provided, of course, you are sensible enough and courageous enough to ignore it and to capitalize on those down days and to keep putting in your direct debit and keep just turning a blind eye to the noise.
Yeah, it's really that consistency that results in you being able to meet your goals over time, being able to actually benefit from what volatility provides you. Because if you do go through a period of volatility, especially when the volatility is towards the downside, people tend to panic and they want to stay away. But it's actually a really good time to invest. And those debit orders going down now are actually going into assets at bargain prices, and you'll reap the rewards later on. And also, by not freaking out when things are volatile and things are uncertain and not withdrawing your funds, you're able to benefit from that upside as well, and to make back anything that you might have incurred paper losses on.
No, exactly.
Because it's only a loss when you actually realize that loss, when
Exactly.
you sell the asset. As long as you hold on and ride it out, and you can enjoy the ride. I mean, I would recommend people not watch their portfolios every day, but I myself can't help it. I look at it every
exciting.
single day. And I'm just riding it out. I'm just being like, okay, well, what's down again today? And then looking at my investment case for what I'm invested in and deciding whether or not I'm happy to stay invested, because I have a long-term time horizon. Whether I'm happy to stay invested in that asset. Let's think about stocks specifically. Has the investment case changed? Is the 10-year view completely different? Have things deteriorated to the extent where I can't trust management and I can't trust what the company's fundamentally doing? And if the answer is no, then why sell it?
I'm reading a marvelous book at the moment by Michael Cardo. He's written the biography of Harry Oppenheimer. And he goes, my goodness me, Michael, you're making me work. I'm speaking to him at the Frontier Literary Festival next weekend, and I'm reading like a maniac because I need to get through the book. But it is so wonderful and so rich and so dense and so full of so many incredible stories and anecdotes. And it goes back to the Oppenheimers and their origins in Freiburg in Germany, and how they move across to the United Kingdom, and how Ernest Oppenheimer is sent out as a young man to the diamond fields to exploit an opportunity that the Dunkelshof family sees in Kimberley.
I think you're ready, Bruce.
And he sees it, and he sees this wonderful opportunity, and it's glorious, and he loves it, and then he becomes the mayor of Kimberley, and then World War I happens, and he gets chased out of town by mad marauding mobs. But into the 30s, and he is friends with people like Punch Barlow, for example, the founder of what is today Barlow World. And Punch Barlow, in the 1930s, secures a deal to distribute Caterpillar equipment in Africa. What is Barlow World's primary business today? Caterpillar Equipment. Nearly 100 years later, these guys are doing exactly the same thing. Hopefully better, hopefully more efficiently, and with more markets. I think they get nailed in Russia. But it's just, and what I love about that little anecdote is the more things change, the more they stay the same. And actually, good people running great businesses with great product and great networks are going to be great in perpetuity, and until they're not. But this is one that stood the test of time, for example.
Yeah, and great people with great businesses, and I actually think you used this example in one of your books. Is they also look at times of turmoil and times that are extremely tough and awful. And Adrian Gore with Discovery is the example that you used.
Roughly in the week that Justice Malala writes about in his new book, we're so nerdy. We're comparing books. We're doing a book off. This is like book club on a Tuesday night. Just there's no wine. It's a rubbish book club. But Justice Malala talks about those 9 days, of course, following the assassination of Chris Hani, and just how all hell's breaking loose. Around that time, Adrian Gore sitting by himself at RMB with Laurie Dippenaar and G.T. Ferreira and Paul Harris is in the background somewhere, and he's kind of plotting a business for the future because he's not worried. I mean, he doesn't like what's going on, but kind of there's this idea of this too shall pass. And that we're preparing for an environment that will be different to this environment, and we need to serve that environment. And that's what they think about.
Yeah, and this is what great entrepreneurs think about. And these are the companies that will probably have on the equity market in the future that are actually starting today while we're at stage 6 load shedding until further notice. These kinds of individuals exist in this market, I think more than anywhere else in the world. And these are the companies that we'll have in the future. And the companies that we have listed on the JSE right now, the SA Inc. companies that are so hated offshore and that are actually being called value traps by some.
Well, somebody was saying, is South Africa a value trap?
Yes. These companies are fantastic, and they service a large market, a growing population. It's just a really tricky time right now. And this too shall pass. So you have a situation where you have the opportunity to invest in an equity market that not only has these kinds of stories attached to it, but you also have a really well-diversified equity market because it has a lot of offshore exposure as well. So you have the opportunity to invest in a fantastic equity market. I just looked at the 10-year return, 10.5% per annum on a total return basis over the last 10 years.
In rands.
In rands, yeah. But that if you've got rand liabilities in future, if you want to retire in South Africa, it's fine.
Exactly.
Right?
But are you beating inflation? Yes, you are.
Yes, you are beating inflation by 5.5%. If you invested your money in money market at exactly the same time, it would have given you 6.2%. That is a real return of 1.1% per year. So at least it's positive, but it's not great. I mean...
But in real terms, and because our inflation is not... your inflation, my inflation are going to be different things.
Yeah.
And if you are poor, your inflation is very different to somebody who is wealthier, because most of your money is spent on basics, food, a roof over your head, transport, and electricity. And those are the 4 things that are going up in double digits. They're going up faster than anything else. So your experience of inflation is considerably worse than somebody who has a broader basket of goods and services that they're buying.
Yeah, which makes it even more important for people who have very little to save to actually save a little bit more aggressively to keep pace with their inflation.
And it's such a hard thing to do because so much you don't have disposable income because that income is being corroded by higher interest rates, by inflation. So we've got to look at a couple of things. We'll get back to the point because we've done, we have digressed a little. Getting back to the point of what really is high risk. High risk is taking no risk or low risk. I would argue that the biggest risk you can do is to not take risk.
Yeah, I mean, I think it's one of the biggest risks. One of the other biggest risks is just putting all your eggs in one basket. What a disaster. You don't just back one horse. Not in investments. You have to be well diversified across asset classes and across instruments. So by instruments, I mean different companies if you're investing in equities. But taking absolutely no risk, putting your cash under the mattress or putting your cash just
That's the riskiest place to put money in South Africa.
Is super risky because even though over the last 10 years you would have had some sort of return, it's very small, but it's positive if you account for inflation. That may not be the case in future. You could have a situation where, because these rates are so close to each other, the interest rate and the money market rate and the inflation rate, it can actually be negative, and you can actually see your value of your investment erode over time. Taking no risk is, I think, the number 2 biggest mistake in investments.
There we go. And the number 1 is putting all your eggs in one basket.
Yes.
Chantal Marx is our guest this evening. We've got questions for Chantal on risk, on volatility. If the volatility scares the living daylights out of you and you're thinking, I'm just going to wait for certainty, I'm just going to wait until things improve, I've got bad news. There's always volatility. There's always uncertainty. There are periods where markets tend to go up. It's called a bull market. There are periods where markets go down. It's called a bear market. But in that bull market and in that bear market, there is always going to be a reason to not invest. The wind's going to be blowing from the wrong direction. There's going to be a trade war happening. There's going to be an invasion of a foreign country happening. There's going to be an oil price spike. There's going to be a food price increase. There's going to be a riot on the street somewhere. You're always going to find 100 good reasons to not do it. Let's give you some reasons tonight to do it. More with Chantal in a moment.
The Money Show. Investment School.
Chantal Marx is the head of equity research at F&B Wealth and Investments. She's with us on The Money Show this evening. So if we look at volatility and we say volatility equals risk, is that oversimplifying it?
I think it's absolutely oversimplifying it. It's just the official measure of risk, but risk to each and every individual person is completely different. So when we assess volatility as the key risk item, obviously you're going to say, well, equities are super risky and cash is super safe. But when you start looking at things like inflation, which we've already covered, when you think about things like taxation and the fact that a safe asset class like cash is interest bearing, you get taxed 40% on that interest, which is completely different to what your experience would be on the equity market. And when you think about things like exchange rate risk, I'd argue that your risk in a low risk asset class is actually a lot higher than what is simply implied by looking at volatility.
Okay, we've done inflation. Taxes are an important part to understand here as well, because you think you're going into a low risk asset. So, I don't know, you sold a house or you inherited a property and you sell it for R1 million and you think, oh, I'm safe and secure forever. I'm not going to take any risk with this R1 million that Auntie Myrtle that I never knew existed, so I don't even feel sad. Don't we all want an Auntie Myrtle? I don't even feel sad. And she left it to me because I was the last surviving relative, and it's that dream we can all have. I'm going to put it into a government bond at 7.5% or 8% or whatever the R156 is paying, or whatever the case is. And you put it away for 5 years and you feel incredibly smug and incredibly clever. During that time, the rand loses 20% of its value. Inflation goes up and down during that time. And equity markets go up 25% during that time. Dividends are paid. And at the end of it, you get your cash back and you go, thank goodness for that. And then SARS, Enriquez Veta comes knocking on the door because he does it personally. And he says, oh, but by the way, I'm going to have a big chunk of the money that you've earned as interest.
Your marginal tax rate. So that can be very large if you are in a high bracket.
Yeah.
But I think in many cases, for people who actually have the ability to invest, it will probably be more than what you would pay in the equity market. So in the equity market, you pay 20% on dividends and you pay 18% CGT, give or take a few calculations in between. Just for simplification purposes. So it's around about 19, it'll probably be about between 18 and 20% overall of your returns that you get out of the equity market. If you are in a 40% tax bracket or a 35% tax bracket, that is what you pay away if you are earning interest.
Bye-bye a third of your money at least, yeah?
Absolutely. So you have to think about those things as well. So not only when you are investing in a low risk asset, you are also you're struggling to keep up with inflation. You also have to pay away way more of your returns than you would if you were invested in a high risk asset like equities.
Then how do you then decide what your appropriate level of risk is? Because if you say to people, most people, this is an Adrian Gore story, everyone thinks they're an above average driver, and you ask an audience of people, who's an above average driver, and 9/10 of the audience put their hand up. Are you risk averse? Of course I'm risk averse. I'm brave, I'm courageous, I ride a bicycle in Joburg. I'm skrik for niks. But don't lose me money.
Yes. People don't like losing money. There's a lot of psychology that goes into it as well. But loss aversion is one of the major investment biases that we struggle with every day.
You feel considerably less joy from a 10% gain than the pain you feel from a 10% loss, for example.
Absolutely. So we are inherently loss averse. We do not want to even have paper losses. By paper losses, I mean you haven't actually sold anything. You still own the asset, but the market is down. And people don't like seeing that. They panic. They sell their investments. And really the best way to actually start thinking about your risk profile is actually looking realistically at how much time you are going to be in the market. So, and also what your goal is, right? So if you are trying to save for your kids' school fees next year, Jan, equity market probably isn't for you.
No.
Right? So you are going to invest in a safer asset. You only have a 1 year time frame. If you make a big loss now, it's a disaster. You also don't necessarily have to keep pace with a lot of inflation. You just have to allow for the next year. The flip side is that if you are saving for your retirement, you want to earn an income one day, but you don't want an income that compares to your income now, but you don't want to save that every single month because you will have no money to spend, and you have lots of time.
And the thing is, and for most people, and this is the Buffett philosophy of, he's very happy for any beneficiary that he leaves money to have their money put into the S&P 500. Trust America, back America. It goes up and down. America makes a plan when things go awry and fixes stuff, and he's been proven right over 85 years of investing. I mean, he's been doing it since he was a kid, and he had his latest Omaha shindig last weekend with Charlie Munger, and they're both looking very sprightly in their 90s. Charlie Munger closer to 100 than Warren Buffett is. When it comes to investing, though, and Warren Ingram tells us this on a regular basis, just buy an index fund. Buy a unit trust. If you want active management, buy a unit trust. And make it a balanced unit trust. Have a bit of bonds, have a bit of property, have a bit of cash, have mostly shares.
Yeah, and that's a very important point. I mean, you need to be well diversified because you don't only want to be in shares. You want to smooth it a little bit. But I think that the best way for a retail investor to get involved, especially when they're looking at how they allocate their saving funds, is start by backing the professionals. So either get a financial advisor to help you with picking specific instruments, or invest in unit trust funds. Even as a professional investor, most of my savings are in unit trust funds.
But you've got a day job, and you also, again, because of knowing what you know, and sometimes too much information is a dangerous thing when you mix all of the knowledge that you have with the natural emotion.
Yeah.
But I think if I cut you, you would bleed. You are human. It's better to outsource that stuff.
Yeah.
I mean, yes, you can take a throat lozenge for a sore throat, but sometimes if it's tonsillitis, you need to see a doctor, get some antibiotics, for goodness sake.
Absolutely, or a second opinion.
Yeah, exactly.
At worst. So I think unit trusts are a great way to start when you're looking at bulky investments and long-term investment goals like retirement. Just kind of stay away from it a little bit. Then, of course, you also have your emergency savings, which you would want in something that's low risk, about 3 months salary's worth. That's
6.
the thing that people say. Don't put solar on your roof because you won't have investment.
Yeah, exactly.
Don't use your emergency savings for your solar. That is a valuable lesson that I can.
Really? No, but now you have solar.
And now I do have solar. I think I'm a much happier person.
No, but there's something to be said
savings.
for peace of mind, and it was an emergency. And,
Yes.
And especially with young kids, I think it's an imperative. So sorry.
A 1-year-old with stage 6 load shedding isn't the best. And then I think that it's always great to have a portion of your savings to allocate towards having a little bit of fun as well. So staying close to the market, and the easiest way to stay close to the market is to have your own portfolio and to to not bet the house on it, but to stay close to the market, to buy companies that you believe in.
So what are you believing in? I mean, even if there's a theme or a trend or a view on where we are at the moment. Because people are moedeloos, which is English for despondent, and are so grumpy and are so fed up, and understandably so, and it's entirely justified, and you're right to be cross. But being right doesn't protect you from the future. And so how do we protect ourselves from the future in terms of investing? What are you thinking?
So, I mean, we spoke a few months ago about fear and greed.
Yes.
Be greedy when others are fearful. So the stuff that I really like at the moment is the stuff that everyone else hates. So I think it's a really opportune time to look at SA Inc.
Okay.
The exchange rate is very weak. It's very expensive to go offshore and to look at and to invest in rand hedge stocks. In South Africa, you basically have some of the best companies, I think, in the world on sale at the moment. And I think really interesting sectors are consumer discretionary companies like the Foschini Group, Mr. Price, solid retailers that are expanding both organically and acquisitively, venturing into new kind of business areas like Mr. Price going into school clothes.
It is astonishing. I don't know where they find the time, the energy, the flexibility from these guys, because they are contortionists when it comes to flexing and finding new business opportunities. It's amazing.
Absolutely. And then I also really like the banks and the insurers in South Africa at the moment. I think the banks have caught a cold from the US that they really shouldn't have. Just in terms of the negativity around those stocks at the moment, but exceptionally well-run businesses with very strong balance sheets, and the opportunity to actually benefit from some of this chaos. I think we're going to see massive levels of capital expenditure in alternative energy solutions. And
it's happening.
Exactly. And these things are going to be financed. They're not going to be financed from emergency savings like I did to my house, but they're going to be financed by the banks. And you just have to think through the current terrible situation and realize that none of this stuff lasts forever. Even
it's
though
a Tom Hanks
like
quote.
It's going to.
I saw a video of Tom Hanks the other day, and somebody asked him, and there were just 5 crusty old actors sitting in a circle. And they said to Tom Hanks, and Tom Hanks is a very wise fellow. He can act and he's wise. And they said to him, what do you wish you had known when you started out? And I said, this too shall pass.
Yeah.
And he said, what do you mean by that? No, just in everything. When life is tough, it'll pass.
Yeah.
When life is great, it'll pass. So don't assume that life's going to be great in perpetuity. Don't assume it's going to be bad in perpetuity. It is going to be multifaceted, textured, flippant, terrifying much of the time, but joyful and exuberant and profitable other parts of the time.
Yeah, and I think that's how you have to approach your investments as well. You need to take those opportunities when they come around, and you need to stay away from the tips. You can basically call a top of a specific stock or a market when you start getting tips around the Bryflace fire.
Who can afford meat anymore? Chantal Marx, thank you very much indeed. Chantal is the head of equity research at FNB Wealth and Investment.